Listen up, folks. Today, we're diving into the exciting world of equity markets. It's where the big money moves. It's where fortunes are made and lost. Equity markets are the backbone of our financial system. They're where companies sell ownership stakes to raise cash, and where investors buy those stakes, hoping to make a profit. Now, don't get scared off by the fancy term equity markets. It's just a fancy way of saying stock markets. That's right, we're talking about stocks, baby. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company. You become a part owner, no matter how small your stake. All right, let's talk about where all this action happens. The stock markets. A stock market is like a big marketplace for stocks. It's where buyers and sellers come together to trade. But instead of fruits and vegetables, they're trading pieces of companies. The stock market's main job is to bring these buyers and sellers together efficiently. Now, there are stock markets all over the world, but the big dogs, the ones you've probably heard of, are right here in the good old USA. We're talking about the New York Stock Exchange, NYSE, and the NASDAQ. The NYSE is the granddaddy of them all. It's been around since 1792. All right, boys and girls, let's talk about stock indices. These are the numbers you see flashing across the bottom of your TV screen. They're like the vital signs of the stock market. An index is basically a group of stocks that represents a part of the stock market. It's a way to measure how well the market or a part of it is doing. Why do we need indices? Simple. There are thousands of stocks out there. It's impossible to keep track of them all. Indices give us a quick snapshot of the market. They tell us if stocks are generally going up or down. They're like a thermometer for the market's health. When indices are up, investors are usually happy. When they're down, that's when people start to worry. Now, there are lots of indices out there, but the big three in the US are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite. The Dow is the oldest and most famous. It tracks 30 big, important companies. The S&P 500 is broader. It follows 500 large US companies. Section 4. Calculating major stock indices. Now, let's get into the nitty-gritty. How are these indices actually calculated? It's not as simple as you might think. Each index has its own method. Let's break it down, starting with the granddaddy of them all, the Dow Jones Industrial Average. The Dow is price-weighted. That means higher-priced stocks have more influence on the index. They add up the prices of all 30 stocks and divide by a special number called the Dow divisor. The S&P 500 does things differently. It's market cap weighted. That means bigger companies have more influence. They take the market value of each company, add them all up, and divide by a certain factor. This method gives more weight to giant companies like Apple or Amazon. Section 5. Common stocks, the bread and butter of investing. All right, folks, let's talk about the meat and potatoes of the stock market, common stocks. When most people think of stocks, this is what they're thinking of. Common stocks represent ownership in a company. When you buy a share of common stock, you're buying a tiny piece of that company. You become a part owner, no matter how small your stake. Now, owning common stock comes with some perks. First off, you get voting rights. That means you have a say in big company decisions. Usually, one share equals one vote. If you own a lot of shares, you have more voting power. This is how big investors can influence company decisions. Another big benefit of common stocks is the potential for dividends. Dividends are like a bonus payment to shareholders. Not all companies pay dividends, but many do. It's a way for companies to share their profits with their owners. That's you. Section 6. Preferred stocks, a different flavor of ownership. Now let's switch gears and talk about preferred stocks. These are like the fancy cousins of common stocks. They're called preferred because they have some advantages over common stocks, but they also have some drawbacks. It's important to understand both sides. The big advantage of preferred stocks is dividends. Preferred stockholders get their dividends before common stockholders, and these dividends are usually fixed at a specific rate. That means you know exactly how much you'll get. It's more predictable than common stock dividends. This makes preferred stocks attractive to investors who want steady income. Another advantage of preferred stocks is priority in liquidation. That's a fancy way of saying if the company goes bankrupt, preferred stockholders get paid before common stockholders.